Welcome to the source of commercial real estate, where we talk to the experts in commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Ethan Elser with PACE Equity. Ethan Elser is the executive vice president and a principal of PACE Equity, the leading funding of CPACE for commercial real estate development projects in the country. PACE Equity is known for both pioneering several innovations in CPACE, including ground-up construction, as well as providing its clients a turnkey solution for all the CPACE requirements. And if you are unfamiliar with CPACE financing, we are going to go deep on that today.
Definitely.
Ethan oversees the company's 25-state origination platform, underwriting. He also sits on the firm's investment committee. He's responsible for the underwriting and structuring of all PACE Equities projects and collaborates with owners, developers, brokers, lenders, and public officials. Prior to joining PACE, Ethan managed a family real estate portfolio, real estate investment office, and was an asset manager for receivership and REO portfolios for banks. So, Ethan, apologies for butchering parts of your intro. I am grateful that you're here, and I think we're going to unlock a ton of opportunity for real estate investors that a lot of investors just aren't familiar with. So, Ethan, thank you for being here. How are you doing today?
Yeah, doing great, Jonathan. Thanks so much for having me. Excited to be sharing the gospel, so to speak. I think, what we do here at PACE Equity and the commercial PACE tool, and we'll talk about, about what that is and what that means. It's probably the secret in commercial real estate financing, and especially today, during our, kind of challenging, capital times, we are, I'd say, more valuable than ever. So looking forward to spreading the word to all of your listeners.
Well, I'm sincerely looking forward to it because when I heard about you and I heard about what you do, I thought, wow, this sounds like an incredible opportunity. And CPACE financing is something that I myself am ignorant on. So really looking forward to shedding the light on this really important topic. Why don't we get started by you telling us a little bit about your background and what your work looks like today?
Sure. Well, and I've been really fortunate to kind of be here today and to really kind of have all the different parts of my background, build up to what I'm doing now. So, as you mentioned, I started off working, really in the Great Recession, working with banks who were taking back, receiverships on REO properties. And I was brought in to kind of help work out the asset management and disposition side. So I worked to, take properties over, get property management going, kind of stabilize and turn them around as kind of time and money allowed, and then work, to ultimately liquidate them. And it was a trial by fire, great way to get into the industry. Learned a lot, and again, just built a knowledge base around property management. I have such an appreciation for what those folks do. It is I think it's the hardest and most underappreciated part of commercial real estate. I was then brought on to a local family here in Milwaukee, which is where we're based. Great folks. They'd really started an investment real estate division, and they sold a kind of a legacy family asset at a fantastic time, but then unfortunately, fortunately, 1031'd all of that into starting this investment real estate division. So they sold high, they bought high, and 1031s are great in some ways, but you still have to, really be thoughtful, around how you're exchanging your properties. And so I was brought in that same way, now at a kind of a first party ownership level, to stabilize, turn around, grow NOI, develop some new assets. And what was the opportunity was that we were really just resetting a lot of those different aspects of the company. But what was challenging was we didn't have a lot of capital to do it. And so I had to be very creative in every leasing deal, every, JV development deal. We had a lot of land that we had to, kind of partner with and figure out, how to develop new assets with. So I was always tap dancing my way through projects and financing and looking for creative edges, right? And it sounds like, a lot of what your listeners are looking for. And there came a scenario where it was a really big TI project, what felt like really big at the time for me at least, and I just couldn't get the cash I needed, and lenders were just not lending, and so I'm really working hard to find different alternatives. And one individual said, I just heard about this new company started in Milwaukee who's doing this new tool called CPACE. I'm like, never heard of it. Don't really have time to. I got to get this project funded, man. And then I kind of thought to myself, I actually do have time because I got to figure out how to get this done. And ultimately, I got introduced to a gentleman named Bo Engman, who had recently left Johnson Controls, who's based here in Milwaukee, and started Pace Equity. And he explained what the tool is and what his background is and how it worked, and said, this is exactly in our wheelhouse. We can get this project funded for you. And it was just like, but I've never heard of this. How does this work? Is it real? So I went really deep in and ultimately signed up. I learned later as one of the original customers of the company. And I was just fascinated by this tool. This is about 10 years ago now. And I was just so enthralled in it that eventually said, this is great. It's here in Milwaukee. I love that we're supporting, my hometown. I'd love to come join you and do this with you. And Bo said, that's great. We're ready to scale up our business. Why don't you come start a sales team? So, and that was, kind of going on, 9, 10 years ago now. And it's been a great ride.
What an incredible story to get into your current position. I love that you were one of the first customers and you loved the product so much that you wanted to work for them. I think I can think of few better ways to get involved in a company, and
Exactly.
few better testimonials for a company or a product than for you to want to work that yourself. So let's get into CPACE financing, because
Absolutely.
I know a lot of investors might be ignorant like me about it. So whether you want to explain it in the context of the project that you were working on, that might
Sure.
be interesting.
Sure.
But just give us an idea of what CPACE financing is and what it provides investors.
Yeah, absolutely. So CPACE is an acronym that stands for Commercial Property Assessed Clean Energy. Mouthful kind of right there. And ultimately, it's a state legislated public private partnership. What the legislation does, which is set up and active in about 35 states and growing around the country, is sets up a framework for private capital to fund specific items in a commercial buildings construction budget. And when I say construction budget, that could be a renovation, that could be a value add scenario, that could be a TI project, that could be redevelopment, that could be ground up construction, that could be seismic retrofitting, that could be adding solar. So a lot of different applications. We'll come back to those, I'm sure, in a bit. So to fund specific expenditures in those budgets that have a tangible utility, water, or renewable impact, meaning they're things that actually goes to reduce your energy spend, your water spend are renewable in nature. And the capital, all from private sources such as PACE equity, is paid through a long-term special tax assessment on the property. So the idea, Jonathan, kind of big picture, the government, the public, so to speak, they're trying to encourage people just like your listeners to renovate and build commercial buildings in a more energy efficient, a more sustainable, a more job creating manner without putting taxpayer money on the line. So they give us the access to the tax assessment mechanism. Like think about if your property has a sewer assessment, it's the exact same concept. It's just for your specific building, and we're lending you capital to do a specific project. Again, whether it's build or renovate your building, and then paid back through a, let's just say, 20 to 30 year fixed rate, non-accelerating, and non-recourse key special tax assessment. So that's the concept in a nutshell.
All right. I am diligently taking some notes here because
There's a lot to unpack there for sure.
yeah, but the opportunity sounds incredible, and I want to narrow down on specifically the kinds of projects and improvements that could potentially be financed through this vehicle.
Yeah,
So, in the acronym, you talked about clean energy. It's right there in the acronym. You talked about it has to be uh, the property has to benefit from improved utility, water, or renewable impacts. So, can you go through maybe some of the use cases that you've worked on recently? What are some of your clients using this financing for?
absolutely. And what's kind of interesting, when you unpack it, most projects that are doing kind of major renovations or development, or in some cases just some kind of upgrade, qualify. So it's not necessary. It sounds to kind of to your point like, gosh, do I have to do like a lead building to qualify? And the answer is absolutely not, which is great. This is really just trying to give access to capital for specific things like improving HVAC, windows, lighting, elevators, adding solar, roof, windows. There's actually a lot of different things that qualify in most commercial construction projects. So you ask a great question, use cases. And, you know, that's where, again, kind of the world is a little bit of someone's oyster because there are a lot. Big picture, a lot of our clients right now are using us because I haven't even really hit on the main value proposition yet, which is that our capital is supplanting debt and equity either at a similar cost to debt today, but compared to equity at a dramatically lower cost. So where banks are unable and willing to lend, we can step into that void and add some additional financing at a similar cost. Where someone, has raised some equity, but going to the full kind of equity check is very dilutive and not making your IRR work, that's where we can come in and replace it at a much lower cost. Someone who is developing a building has a cost overrun. We can come in and fund that mid construction as just simply kind of cost overrun funding. Someone who is looking to recapitalize. Maybe you'd like to take out some of your equity investors, but you're not ready to do a refinancing because maybe you've got pretty attractive bank terms right now. Maybe you don't want to go into the market right now to try and refinance. We can support that. We can typically fund projects that have been completed, 12 to 36 months ago. So, the world is really the oyster. Um, a project, I was just on a call with someone who's buying a distressed office building, and they're considering two different things for it. One is redeveloping it into multifamily. The other would be simply, I'm acquiring this at a much lower basis so I can lower rents, but I've got some existing income in place, but I really need to just modernize the building, make it a little more competitive. I might need new elevators, new lighting, refresh the lobby. That's a scenario that we can, participate in. So there's a lot of ways, but I think the main, if I'm listening to, all of this, I think the main takeaway is that for financing commercial construction projects, kind of larger or smaller, our capital is very competitively, very value add, kind of priced and structured.
Will you talk about the types of assets that you lend on? Are you restricted to only residential, only large commercial properties? What sorts of assets do you lend on?
Yeah, any kind of commercial, real estate. So multifamily, hospitality, industrial, retail. We are doing, here and there, office. Um, so it's really your main, senior housing, your main, core food groups. But we focus on really, is this a good project? Is this a good, asset for us to be in. We don't necessarily say, okay, we don't like this market for these reasons. We like to look at what's this actual project and does it make sense? Where's kind of the story and the value add to it? And there's a lot of things out there that can make sense at the right basis, with the right team, with the right tenants right now.
Ethan, I'd love to go into the process and exactly how this works. And
Yeah,
I have to admit that when I think about, you mentioned kind of a public-private partnership, and my mind goes to some of the government-funded loan programs where they'll provide some funds for capital expenses and rehab, but there is a laundry list of requirements
right,
and contractor requirements and all these things that you have to fulfill, and they make it almost impossible to take advantage of this opportunity. So the way you were describing it, it seems pretty flexible that you can even do it in hindsight and retroactively for
right,
a
right.
project that is potentially even already completed and you're looking to recapitalize or pay off some investors. So um, let's start out with requirements.
Yeah,
So yeah, somebody comes to you and let's say, they're wanting to rehab this office building, and they're wanting to freshen up the lobby and the elevators and add some LED lighting, and they've got this list of things that they would like to do, and they're wondering if you're a good fit for it. So what sorts of requirements does the investor or the borrower have to go through in order to secure this financing?
sure. And, I'll start off by saying our company, I believe we add value in a sense to your exact point, Jonathan, which is that while we do our absolute best, there are requirements that have to be met. And a little bit of the challenge in our business, in our space, is that, as I mentioned earlier, there's 35, and growing states that have the requisite approvals and legislation in place, let's just say at the state level and locally. Unfortunately, each of those is different, sometimes a little bit, sometimes a lot. And how we add value to our clients is by being very granular. So, first and foremost, if you were to reach out to us with that exact office project, we're going to look at it based on, okay, this office building in Seattle. Okay, now we have to meet these sets of requirements, and we're going to shape our whole process around that because actually, in Seattle versus Spokane. Those are actually two different sets of requirements, which is different from Oregon, which is different from California. And I don't say this to try and scare anyone, but the point is that that's how we add value is having an in-house team of experts on the transaction side and the engineering side to meet all these different requirements and have it be, in the end, a simple and approachable process. So I'd say, there's five criteria that we look at initially, upfront to come back with ultimately, let's just say kind of indicative terms of financing. So one, and let's just say that we can make some of the assumptions, the more the merrier as always, but we look, very closely at first the scope of work. So having that budget of, okay, how much is, elevators is $1 million, lighting $200,000, whatever the case may be, so that we can come back and say, okay, we can fund this, this, and ultimately come back with that. Two, we look at, what our LTV is, and this is actually a really good thing to mention is that, we're not a first mortgage lender. We're a gap filling lender, of sorts. We're typically funding up to, 20 to 30% of the ultimate LTV of the property. So it's a nice accretive part, absolutely, but we're not again going to be that first mortgage lender for a wide variety of reasons. So we're looking at that. We're looking at what the ultimate equity is in the property. We're looking at, again, what those local requirements are and what we ultimately have to meet. And then finally, And maybe most importantly, we're looking at debt service coverage, underwriting to, different requirements based on different asset classes. So what our team is going to do is we're going to ingest this information and come back with something that's very tailored and specific to your building and your location and your project that you're doing. And we do that through a team of about 20 managing directors, coast to coast, who are local to most major MSAs in the states that we funded. And that way, you're not talking to Ethan in Milwaukee or Griffin, who's our Wisconsin managing director. You're talking to Rachel in Seattle, or you're talking to Ron in San Francisco, or Dan in Miami. And that way, it's someone there who understands all these requirements, who has an interest, in your city or state. And then we can, again, get very granular with you about how to tailor this to fit your needs.
Are there project characteristics or types that right off the bat you can hear and say, you know what, this is not going to be a good project for PACE?
That's a good question. I think at the end of the day, we are a commercial real estate construction, lender. And again, being very broad about what construction, renovation all the way through ground up means. And, just where we are today is that, doing a project where we're funding $1 million or $50 million is the same amount of work. And so what we found is that if our portion is less than that $1 million, it's hard really on the borrowers because we have the same costs and overhead, and unfortunately we have to kind of pass that through. So I think for us to fund $1 million or up, and plus or minus, there's no hard and fast rules, which if you kind of do some reverse math on our LTV, is probably going to be a $5 to $10 million maybe total project cost or up, assuming that we're funding 20 to 30%, thereabouts of it. But at the same time, I think if you're in a state we can fund in and you have a need, and we want to be working with you. Our ultimate mission, is to help support these projects, especially the ones that are embracing, more efficiency, renewables. So someone reached out to us, had a $400,000 solar project, and it's usually, typically not something we'd consider, again, for some of those reasons, but we really want to support that person's mission to ultimately reduce their utility consumption, reduce fossil fuel emissions, and we were able to, to work with them on it. So I think, larger projects are better, but it's really about where does that need exist, and how can we be accretive to that? We're not necessarily a great fit for every single project. I actually just got an email from one of our team members, and they said, well, they're talking to us, and they're also considering traditional bank financing. And I said, you know what? That's probably going to be a similar or cheaper cost, than we are. Typically would be cheaper. We're just in a little bit of a weird spot right now in the market. Everyone should maximize their lowest cost of capital first. And it's okay if that's not us, because we're not a bank. We don't have deposits. We're a private, lender. So I think first and foremost is, exhausting some of those other options. And then we're here to really step into that, that gap or that void.
Ethan, you touched on it a little bit, but I'd like to hear more about PACE Equity's value proposition. So,
Absolutely.
you mentioned somebody should go to their local lender, and maybe a line of credit is the appropriate financing source for a certain project. You talked earlier about some examples where you were working on a project and you couldn't get local lending for a TI project that you were needing to do. And so talk about what an investor can expect with PACE Equity that they might not get from a traditional lender. What
Yeah.
is your value proposition to investors?
Absolutely, and that's a great question, Jonathan. I think you know everyone has a little bit of their own perspective on this. So I'll give you kind of a couple that apply to many. Um, one is that after construction is completed, we're a non-recourse lender. So there's some folks who are just they'd rather just not have that hanging over their head, or on their personal financials and balance sheet. Um, Two is that we can often what's attractive about our structure is that we lock an interest rate for our entire term and amortization. There's no rate reset, there's no balloon payment. It's just a straight line, say 20 to 30-year amortization. So what's nice about that is one, in a rate increasing or questionable environment, you're not taking that risk. You're going to know exactly what your payments are for that 20 to 30-year time horizon, and really as a result we become very predictable, but we can usually extend a longer amortization than banks. Like taking TI projects for a second, there's a project here in Wisconsin that we're working on. They have a TI loan, and it's a 5-year term and amortization. I mean, it is punishing to that property's cash flow, right? We are doing the exact same building, exact same project, and we're extending a 25-year term and amortization on that. So that in itself just may be more compelling because to the bank, they did an acquisition loan. This is kind of a second, junior loan, and they wanted to keep it, very tight. Whereas we think about the world just differently. So those are some of the nitty gritty. But let me go like the ultimate, main one, which is that banks right now and lenders right now and equity right now, it's scarce. There's a real scarcity as we sit here in early 2024, with that. They might want a big deposit. They might only lend to existing customers, but they're really limiting the amount of financing that they're willing to offer. And that is our main value proposition. That let's just say your local bank is only offering you 50% leverage. Your project probably doesn't pencil, if it's that low. Or maybe they're willing to give you an acquisition loan, but they're not really willing to fund the rehab or the renovations or a chunk of the construction. That's where we're coming in, is that they've kind of maxed out what's probably the most attractive cost of capital, and we're funding on top of that and in a creative way that's a similar cost, that's non-recourse, long term, to really bridge that gap between what a lender's willing and able to do and really what it takes to make the project pencil from an investment and return perspective. That's really our main sweet spot. And that could be on the debt side. That could also same be on the equity side, where if you think about that same scenario maybe a little bit differently, if your local lender is only willing to lend 50%, let's just say that means you're bringing in 50% equity, whether that's your own pocketbook, whether you're getting outside investors. That's a lot of capital. That's a lot of return that you're tying up. You ultimately probably can't do a project like that or many projects like that. So this we can be a way to say reduce that from 50% maybe to 30% or 20%, depending on the particulars. And ultimately, that makes the returns higher for you and or your investors. That may mean you can, it'd be great. Like you and I could go buy a building together instead of having to bring in all these outside partners. We kind of keep it more, in the family, so to speak. So those are just some of the main ways that people are using us. But, we're really, again, bridging that gap between, what lending is out there and really what it takes to get these projects to make sense for owners and investors.
Ethan, I know you've worked on a couple really interesting projects recently, one in Texas, one in Vegas. I'm sure many others. Would you be willing to take us through a recent interesting deal, kind of from start to finish, and fill in the gaps of what your role was in those deals.
Yeah, absolutely. And I would encourage, without trying to be too commercially, if you go on our website, pace-equity.com, there's a whole case study page, and we segment that by, by geography, by asset class, and chances are we've had, some experience, either the same you're looking at or, very like kind. But I'll give a different example actually of a project that I think, again, it really speaks to the market today. Um, this was a new construction hotel outside of Kansas City in Missouri. And they had actually gone ahead and started construction. This is a ground up, development project. They had started construction, accomplished, well-heeled, sponsor individual, because he had a construction lender, but he wanted to strike while the iron's hot. His pricing was in, all the, the incentive package was there. So, okay, I'll go ahead and get started, and just the financing will kind of catch up. And ultimately, he was working with a really great bank, but they were getting a participating bank. And what ultimately came to fruition is that the participating bank, was not able to perform for, I don't actually know why, but let's just say for some reason. And so now all of a sudden, what made a lot of sense to do, you've got a big surprise in your capital stack. And so, through different relationships, we have, he ultimately got introduced to us, and we were able to fill in. If it wasn't all of it, almost all of that participating bank, and closed in about 40 days, which is for us light speed. Let's just say, but it really kind of saved the day from having to, again, scramble, shut down construction, go find another participating bank, go to outside investors. So that's one that comes to mind. I'll give you another one, which is again a very common scenario today. This was a multifamily project in I think it was in Cincinnati, or so, and they had a very traditional, they had acquired a building, they were redeveloping it from, I think, office into multifamily conversion, and ultimately they had a lot of cost overruns. This was, still very much the case today, but very, very present, coming out of COVID. And so they had about a $4 million, gap to finish the project. They had, leveraged all the equity, almost all of the construction loan. They just really didn't have enough proceeds to finish the project. And again, you're left in a really bad dilemma. I could do a capital call, which is so punishing, and that would be a big capital call, at that. The bank isn't really that interested in funding something like that. So ultimately, same, they came to us, and using costs they hadn't incurred yet, costs they had already incurred that happened to qualify, we were able to fund the entire cost overrun and see that project, get completed, even though we hadn't been involved until it was maybe 85%, redeveloped. So those are two, more recent, projects, but I'll just tack on a third, which is that a project was, they were getting a bridge loan, to complete, their renovation and construction. And we think banks are expensive right now, those bridge lenders, and we work with a lot of them. They're great folks. They have a really good value in today's marketplace, but they're very expensive. They're a big premium to where banks are. And we were able to work with them to ultimately lower our cost is 200 or 300 basis points below theirs. So we were just able to actually reduce the overall cost of capital for that project simply by just taking, the amount they were borrowing from that bridge lender and reducing that by our funding.
Yeah, incredible. I'm sure some listeners' ears perked up with that last one.
Oh, good. Okay,
I'm
perfect.
sure. Well, I'm sure there are some people that are or will be starting to feel some pain from bridge lenders, and so I think if there are any signs of hope, any opportunities for help from a bridge lender with interest rates that maybe just doubled or even more,
Right.
I think there could be a real opportunity there. Ethan, as we wrap up our conversation, is there anything else about PACE equity or CPACE financing that you wish people would understand? Any any misunderstandings out there, or if you could just get in front of investors, what would you like to tell them about this type of financing?
There are, we are probably the most unknown and at the same time misknown, products in the marketplace today. And, that's because maybe in, let's just say, Maine, you know, we just got started, funding projects there. So probably people in Maine have never heard of, of CPACE and PACE equity and what we do. And then there might be, Florida, a state where we've been funding projects for a long time, but there's even though there's still a lot of people who are, not knowledgeable on what we do, there's probably more who misunderstand, through, different, reasons. So I think first and foremost, just, understanding if this is a fit and being open to that, you might not have awareness or you just might have a misunderstanding. I talked to someone in Florida 2 weeks ago. Again, this is one of the older markets that established that legislation. And they said, I didn't know you could fund construction. I thought you were just for solar. Now, I mean, that's not wrong. We can just fund a solar project, as we talked about earlier, but more of what we fund are these, these construction and development projects. So there is a lot of that out there. But again, I think, just what I touched on earlier too. There's different requirements, public-private partnership. It sounds overwhelming. And that's again where really we've built Pace Equity to help you navigate through, whether it's to, take care of these requirements for you and or guide you through the process of working through these different states and districts so that this becomes a very, accessible capital tool for you. So like I said, just reach out. We're here and able to support and help you.
Ethan, this has been a great conversation. I know
Same.
I learned a ton about a new potential funding source for my future deals. So, sincerely appreciate your expertise and going deep on some of your success stories and how CPACE financing could be a potential option for a lot of investors. If a listener or investor wants to find out more about PACE equity and wants to find out if this could be an option for their project, what's the process and where would you like to send people?
Yeah, if you go to our website, www.pace-equity.com, there's a lot of resources there to learn more about what I've talked about today. Again, to look at some of those successes and case studies, but there's also a get started part where you can submit just the basics, you can submit a lot of information, and ultimately that'll be routed to one of our managing directors, in your area, or just say, unfortunately, we're not funding projects here. We'll reach out, when and if that changes. So I think our website is a wealth of knowledge, on all this and can direct you to the right person.
Perfect. And links to Pace Equity's website will be in the show notes. Ethan, thank you so much for your time today.
Thank you,
Sincerely enjoyed
Jonathan.
this
This was great.
conversation. Perfect. Listeners, if you enjoyed this conversation, feel free to reach out to either one of us, especially reach out to Ethan if you feel like you have a project that could be a candidate for the
Absolutely.
CPACE financing. Listeners, thank you so much for listening. We appreciate you. Until next time, take care.
Thanks so much.